everyone. Today we have a little mini series on introduction to trading and sort of super basic trading strategies and terms. I wanted to get this done in one video, but I think I'm going to end up splitting it in two because it ended up being a little long. Thank you so much for watching.
Hey everyone, what's going on? Today we are doing an intro to trading. This is going to be hopefully a super basic overview of how stock markets came to be and sort of the most basic trading stuff you'll see, terms you'll often hear, and introductory level stuff. This is meant for somebody who has almost no experience with the stock market or investing of any sort. So with that being said, let's get right into it. So the first financial transactions started happening 3,000 years ago. And these were sort of very simple promissory notes or loans. You would go to somebody who had money and say, hey, if you give me $5,000, I'll build a bakery and I'll give you 20% of the bakery's profit for the next 20 years. And this is how transactions happened until about 1602 AD, when the first joint stock company was formed. And this is where a bunch of people came together and put money in to form the Dutch East India Company, which is formally renamed as the VOC, and is sort of the Dutch company that conquers a lot of India. Or not India, I'm sorry, Indonesia. And then shortly after this was founded, the first stock exchange where people could buy and sell shares of these joint stock companies was founded in Amsterdam. And so if you're interested in the nitty gritty and details and history of money, I read a really, really good book called, I'm actually going to pull it up because it's right here. It's called Sapiens, and I honestly think the name is kind of misleading. This book is described as a history of humankind, and it really feels like the history of money, at least to me, and sort of how money affects or has affected humans and how humans have evolved, and the sort of systems we see taking place and shaping the world today. I think this was a really good book. It was really hard to read, I can't lie. It's also pretty long, but overall a very good read and an in-depth history of money and humankind. Yuval Noah Harari? Definitely butchered. Sorry about that. But in 1817, the New York Stock Exchange was founded, which is the picture I'm blocking out right here. But this is sort of quickly grows to be the world's largest stock exchange. This is the most common thing you hear about companies being traded today. I would say most of the sort of big companies you hear about are all traded on the New York Stock Exchange. So with that being said, today there are two big things you hear about a lot when you're reading articles and seeing things today. One is sort of retail traders and all of the platforms they have access to, and institutional traders. And so retail traders are, you, me, and everyone else. Anyone who has money in the stock market that is not tied to a large business. And this is numerically the majority of the majority of the accounts in the market are retail traders now. These were just some headlines I pulled from today that were talking about how retail investors are doing better, and there is more and more retail investors. I also have over here a lot of the retail trading platforms. There's obviously a ton more, but these were a big couple that I instantly recognized the branding and thought it was really interesting how much sort of advertising I see from all of these companies. So then some like really quick common terms. A lot of these, there's a lot of words on this slide. Apologies about that. No pictures, but I just wanted to sort of get all of these out here in one space because they are things I've seen show up a lot when I was reading sort of intro trading strategies, intro stock stuff, looking at putting this presentation together. And so I just wanted to get all of these terms on one page and sort of have a one-page cheat sheet. And like, I think I'm going to try and link this to Discord so it can be like accessible and seen quickly, but like common terms are like shares, which is literally the portion of company you have that is like publicly traded and can go around. Like this is like generally the common stock of the company. There's sometimes some other like classes of shares. This is a lot of stuff that's to do with like founders and startup sort of stuff that it like can carry over into, or like employees at bigger companies. But that's generally sort of fringe stuff. Most of the stock you'll see traded is all going to be common stock, or most of the shares you see are all going to be common stock. So going long and going short means, respectively, going long is you believe that over a period of time, say 12 months, a company is going to do better, and their stock price is going to rise. So like, I would say I'm going long on NVIDIA. That would mean I think the price of NVIDIA is going to rise over the next X period of time, whatever duration we've been discussing. Conversely, going short is I think NVIDIA is going to lose money over a said period of time. Relatively simple, just sort of lingo terminology I often seen get thrown around. Just wanted to make it sort of super clear what those were. Margin trading is sort of borrowing money from all of our friends over here to add leverage to your trade. So I'm only going to put a portion of the money in and get Fidelity or Charles Schwab or somebody else, to whoever I'm banking with, to fund the rest of the trade. And like this increases the leverage I have, so I can make a lot more money, but I can also lose a lot more money. Obviously, margin trading is very risky. Don't recommend it unless you're like way past this point and kind of laughing at this presentation, because the concepts are so basic and this is all very concrete information and you know what you're doing far more than I do. Similarly, market cap or market capitalization is like the amount of money a company is worth. This is a super simple calculation. It is just share price times number of shares in circulation. So like NVIDIA has a market cap of $4.5 trillion, which is like their share price of $188 times the number of shares they have in circulation, which is 238 million or billion, sorry. Forex trading or foreign exchange trading is like trading two currencies. So like today the US dollar is worth, a certain amount of pounds, and tomorrow pounds might be worth more as the dollar keeps losing value. And so you might say, hey, I want to take my $1,000 that I have in USD and put it into pounds because British pounds feel like a safer currency. And that would be like sort of an example of foreign exchange trading or forex trading. This is obviously you need two currencies to do it, but you can also have more. There can be, I think, three-way trades. I don't fully understand all of the details and intricacies of forex markets, but that's generally the idea. Is you're trading currencies between one another because you believe one is going to hold value better in comparison to the other. And a sort of similar note, the index funds and index tradings is trading like groups of assets that you think are, or not that you think, that are meant to be sort of these passive managed funds that like are tracked to a certain index or price. So like there's lots of funds that index to the S&P 500. And so the goal of these funds is not to like beat the performance of the S&P 500. It's just to match it. And all that fund is going to do, if say the S&P is up 8% over the year, the goal of the fund is to bring you, 7.75%, which is 8% in value increase minus a 0.25% commission or handling fee. This is generally thought to be a more safe method of trading because you're exposing yourself a lot less to each individual companies and sort of taking much more broad swaths of the market and taking sort of a holistic approach to investing and trading. This is often thought of as the safest way to trade, and it is like, obviously it still carries risk, but there is something to be said that the index funds are less volatile than a lot of the other sort of options we're talking about. Another sort of safe or sort of even inverse bet are commodities markets or commodities trading. And so this is physical things like gold, silver. Bitcoin is also technically a commodity, although it is not, a physical thing. Like that's a whole different debate. But the idea behind commodities markets is these things sort of have intrinsic value and they're going to hold value regardless of what any of the other markets are going to end up doing. And so you might like buy something like gold or silver if you're concerned that the US dollar is going to lose value over time, or if you're concerned that every currency is going to lose value and continue to grow inflated. Lastly, options trading. We'll get into this a lot more tomorrow. I originally started making a video on options trading and realized it was pretty dense, and I kind of realized I wanted to back up a step and do this sort of broad overview of trading and my current exposure and familiarity.